What differentiates WFG, I think, is that it is smaller. It's private. We're a pretty flat organization structurally. So it attracts a different type of person. And today, actually, fraud.
Yeah.
Our business catches a lot of fraud, and it's probably the highest climbing as a percentage loss in our business today is fraud versus insurance claims. But a construction project can snowball on itself pretty quick if it gets underwater. And depending on who's controlling the money and the draws that are coming, there's a lot of complexity there.
Witness protection or something.
Yeah, witness protection, or stalkers or violence or other things where it's been through the court and it says we're not going to disclose that this person is buying or selling real estate. With great exception, everyone wants to own real estate.
Yeah.
It's not about desire, it's about ability.
Yeah.
And the ability to transact is a function of interest rates, pricing, but also employment and wages.
Right. So today we're here with Noah Blanton with WFG Title. He's the Chief Growth Officer.
Yeah.
So, Noah, I'm super excited to have you here. And, I know our audience may not know as much about title insurance as you do, but it's definitely an important component of the transaction. It's a good place to build relationships. But before we kind of get into that, maybe you could give us a little bit of a background about how you got into, title insurance. I'm sure you didn't grow up as a kid wanting to, to do this. And so, tell us a little bit about, your kind of role in the company, how you got here, and about WFG, National Title, and maybe you can unpack that acronym for us, because it's a little bit of a mystery.
Yeah. Kind of a joke. Yeah.
Kind of a joke. Yeah. Exactly.
Well, thanks, Nick. It's good to be here, and it's good to see you. It's true. Nobody intends to get into title insurance. It kind of happens by accident, and did to me as well. It's a great business, great little niche part of real estate that everybody ends up eventually if they're transacting in real estate.
Sure.
And I've been doing it for 28 years, transactional real estate. Got in.
It's incredible.
I was kind of on the edge of real estate and interacted with title companies and got referred to one. I needed a job.
Yeah. You got in, you must have been super young.
I was young. Yeah.
Okay.
Yeah, I still am young.
You look incredibly young. I mean, people who are watching this are going to be shocked that you could be anywhere for 28 years.
Yeah,
so you look 28.
Well, I feel 75. So they say,
well,
you're only as old as you feel.
That's true. Yeah, that's actually very true. Yeah.
No, I did. I got in young. Yeah, it's been a great business to be in. And so it's given me some tenure in the business at a young age, which is great. I got in customer service, and I was working at an agency at the time, and the president of the company, you did your first review, and in those days you sat down and it was a paper review, and they asked you, where do you see yourself in 5 years? And I said, well, I want your job. So I thought that's what you were supposed to say. Show ambition.
Exactly.
Motivation.
Yeah.
And eventually I did have his job, and it's a great business because, like many parts of real estate, as hard as you're willing to work, you can grow and advance, and it's been a really good business for me. So WFG is a interesting company. It's an Oregon-based company, and we're one of only 6 national underwriters. So we underwrite in all 50 states.
Wow.
And we're only 16 years old. Most of our competitors are over 100 years old, and they're publicly traded companies. Good companies, good competitors.
Yeah.
But we're a private Oregon-based company that expanded 16 years ago to all 50 states, and we do primarily, this maybe will mean something to some of your audience, but not others. We primarily do direct operations in the western states.
Okay.
And then eastern states, we have agency operations. So at our core, and most people, kind of tend to miss this maybe, but at our core, we're an insurance company. We're an underwriter, and we have agents, just like Farmers does, or State Farm, or anybody that could write their policies. We have agents that write our policies as well.
Oh, interesting. Okay. So you're kind of like, so when you talk about direct, you're working with customers directly. It's, whereas the agency might be more of you're like a carrier that people.
Correct.
Okay. Yeah.
And title insurance is interesting. Some people will say, well, how come State Farm doesn't write title insurance? Or how come the big ones don't write title insurance? And it's kind of a throwback to the savings and loan era, where title insurance was carved out. It was deemed important enough that it remained stable. that it was carved out and it's a monoline line of insurance. So if you write title insurance, it's the only type you can write.
Yeah.
And the reserves are a lot of regulatory overlay, reserve requirements. So it's kind of, it's interesting as an insurance product that way.
Yeah. Yeah, that is interesting. And, WFG has grown astronomically, especially in 16 years. Yeah. I mean, I've had Sleep Sound for 18 years and we nowhere near have experienced that level of growth. What do you think separates you guys from your competitors? I mean, like, what do you think has driven that growth? And why are people choosing you guys?
Well, I think first off, we have really good competitors. Our business offers a really high level of service in general, or you don't survive. It's sort of trite to say it, but the differentiator in our business really is service and relationships.
Yeah.
In Oregon, for instance, we all charge the same rates. It's a promulgated rate state. The state sets what our rates are. The rating agency does or approves them. And we all charge the same thing.
That's interesting. I didn't know the state set those.
Yeah. Well, there's a rating agency and the state approves them.
Oh, okay.
So, and some states are promulgated and some states are filed, but most of our markets, there isn't a big price differentiator. So we've got great competitors, and it's a really service-oriented business that I think largely does a great job. But what differentiates WFG, I think, is that it is smaller. It's private. We're a pretty flat organization structurally. So it attracts a different type of person. Our big publicly traded competitors have a place, and so do we. I think people wanted something a little bit smaller where you mattered a little bit more, or maybe you had a little bit more of a direct impact. And then obviously there's the growth story.
Sure.
So for me, it was about coming to a place where I could grow and impact and also have some control over my own career. So it's just a different feel.
Yeah.
And I think it attracts a different type of employee and a different type of customer as well.
Got it.
So.
Okay. Yeah. I think that, I've done a lot of transactions with WFG on the residential side, and I've always had a great experience. I think it's pretty wild to think about. A lot of times people don't realize that it's a unique industry in that you don't get to change the closing date. Right?
Yeah.
And I've worked with a lot of realtors on the other side of the table, and they're not always the most organized and prompt people, right? So there's just so many little grenades that get thrown in everyone's lap at like the last minute or whatever it happens to be. So I definitely think, you've got to recruit special type of people to want to be in that industry and make that work.
It's a very particular type of person on the closing side, and really it on all sides of the business that's successful. And you do need a couple of characteristics, and one of them is you have to be flexible. You got to be able to multitask. And you're right. We don't drive transaction timeline. We respond to it.
Yeah.
And we also don't create transaction volume. We respond to it. So in many cases, our business is in a completely responsive relationship with our client base and the market. And if you're a realtor or you're a developer or you're a buyer, you can go out and you get to choose when you transact. And if you're a realtor, you can mine for business and create transactions. We don't.
Yeah.
And so our job is to be responsive to what the principals in the transaction need, make sure that they meet their deadlines and do our part. And it takes a special person to do it.
Yeah.
No doubt about that.
And, what are some of the, I would say common, misconceptions, you've seen from investors that they might have about title insurance or the role title company plays in the transaction? Are there some themes you see that, if someone's, listening that they could take away from like, hey, this is what people think about it versus not, or is it pretty straightforward kind of product? There's
probably a couple of things. depending on where you are, there are some local customs which I would assume people transacting are familiar with, especially if you're developing or you're in commercial or multifamily residential real estate. But I would say most people that are pretty sophisticated understand it. They understand the preliminary commitment or whatever it's called in the particular location that they're in. I would say the one thing our business is two distinct businesses. One is settlement services and one is the insurance product. You go to the East Coast, you have attorneys that are closing the transaction. We're insuring it. Our role is completely different. On the settlement services side, on the West Coast, where we're both generally, maybe the biggest misconception is that we're a party to the transaction or that we're in some way invested or advocating for the transaction, and we're not.
Got it. Yeah.
Our job is to remain neutral, take instruction, execute the desire of the principals, so long as they don't, violate the law or our policy. And I think maybe that's sometimes the biggest misconception, is that we're in some way or another a party to the transaction. We're not.
Yeah.
And that's good. You don't want us to be.
No, I mean, that kind of defeats the point of a neutral party, you might say.
Yeah.
And so again, why do you think investors should care about title insurance beyond just satisfying a lender requirement? I mean, a lot of times people are like, they're doing it because the lender requirement, but we got into a point of, this day and age where there's a lot of history in title insurance. People may not appreciate like why it exists.
Yeah. I think in terms of a single market, you might in fact say, well, why would I want this? I understand the property. I know the seller. I know, all of these different things. But I mean, essentially it comes down to trust, and it's a fairly modest premium to pay to trust that what you're getting is marketable title, subject to whatever exceptions you agree to, and that you can then turn around and divest yourself of that property at any point in time that you wish. Obviously, for a lender, it's very important that they know that they have a lien position that puts them in the position, whichever position it is that they accept, and that they can foreclose on the property. And individually, you might say, well, I don't need that. As a market, you do need it, because institutional lenders won't lend without that guarantee. And one transaction, it may not matter, but 100,000 transactions, and you extrapolate across that, it does matter for the entire market. So one of the reasons we have low fixed rates in this country is because you have title insurance. And people don't think about where that loan goes that you originate after the fact. It goes to a secondary market, and it must come with a policy of insurance that ensures whoever is acquiring that they also have the right to foreclose, and that they're secured by collateral. So there's kind of this knock-on effect, and it's at the transaction level, but then into the secondary market as well. The stability that the industry provides to lending rates, and today actually fraud. Our business catches a lot of fraud, and it's probably the highest climbing as a percentage loss in our business today is fraud versus insurance claims.
That's interesting. Wow.
So ideally, our product is like any insurance product. You hope never to interact with it.
Yeah. Yeah. Exactly. Yeah.
Except for our product is a look-back product, not a product insuring against a future. So if you never end up interacting with our product, we did our job.
Yeah. Exactly.
And that can make the value of it seem somewhat like, how come this all just works? And well, that's the point.
Yeah. Well, it's kind of like property management, right? It's just like if things go smoothly and you don't hear about it, then we're doing our job, and sometimes people don't realize it's like, we've given you a lot of stability over a period of time, and they're like, I feel like I'm not paying for anything. It's like, well, we logged everything that we did for you during that period of time, then you see the value. But, people tend to realize it when something pops up and it's a problem. So
I think about a bank as an analogy, which is you don't want to hear from your bank about everything that they're doing to manage their operations. You just want to be able to log on your phone and transfer money or send it somewhere.
Yeah.
But the complexity behind that is significant. And the settlement services, title insurance industry moves hundreds of billions of dollars a day. I mean, that is one of our core functions, is settling that transaction and moving that money around. No one wants to understand the complexity of managing that. Everyone just wants it to happen. And if you're a seller, you just want the money to hit your account in the amount that you signed for. And as a buyer, you just want to own the property. And it should be something that you don't think about.
Yeah.
Ideally.
Yeah, no, definitely. And I think that, those are systems that, are pretty incredible. A lot of this stuff really wasn't around 75, 80 years ago. And it radically changed the way the market is. And I think, that's where I wish that people were taught about this on a really high level, at least in school, because what you just indicated about interest rates and the correlation between interest rates being able to be lower and the stability title insurance provides to essentially investors who are lending the money, right? They want the ability to be able to foreclose.
Yep.
That's like a fundamental aspect of that market existing. And it's the same thing with evictions, right? Like, If you don't have the ability to recover your asset, then you're not going to be in that asset class. And a lot of people get upset because they're like, well, people who are foreclosing are evil, or people who are evicting are evil. And it's like, that's actually not the case. Nobody who's doing those things wants to be doing those things.
Yeah.
They're doing those things because that's their last resort. And in order for this, opportunity to exist, it's why people in, most of the world don't own property. I mean, it's just they don't have the markets for it. Yeah. So I think that's interesting.
Well, yeah, I think in both cases, you could see it as the offsetting of a premium that would be paid elsewhere.
Sure.
So if you're going to internalize that risk as a lender, you're going to say, well, I'm going to charge you a higher interest rate.
Yeah.
So which would you rather have, a one-time premium that secures the collateral for the lender, or a much higher interest rate so that they can spread that risk across an entire portfolio?
Yeah.
And I would agree. I mean, maybe at a high level, it'd be great if it was better understood, but that's what we're doing right now.
Yeah. Yeah. Fair enough. Yeah. Can you maybe just like kind of help to illustrate like the value of this? Can you share a real world example where you've seen title insurance protect an investor from a major loss?
Yeah, I can. We had I'll tell you about a actual local story.
Sure.
And so it's not an abstraction.
Yeah.
And then I'll tell you about some larger industry stories as well, maybe.
That'd be great.
But I'll tell you one about fraud in particular, because I think it matters in this case. And this was an investor. This was a single family investor, if that's an okay story.
Yeah, that works. That's great. Yeah.
And we had there was a transaction actually closed. I'll shorten the story, but the punchline is the seller was fraudulent, and the lender had already lent money, and money had already been sent out, and there was the transaction had settled. And the investor went, they were going to take this property, fix it up, turn it into a rental or flip it. I'm not sure what their intention was with it. And showed up, and the owner was there, the real owner. And they said, hey, who are you? And he said, oh, I own the house. And the owner said, well, no, you don't. I own this house.
Yeah.
And he said, well, I got 1-800 junk here to get all this stuff out of the house. And he said, that's my junk.
Yeah.
Anyways, I mean, it was a tense moment. And the point of that was, one of the things that our policy covers is fraud.
Okay. Yeah.
So in this case, obviously the buyer didn't get to keep the property. The deed was fraudulent. So, but there was a certain amount of money that had already been dispersed and could not be recovered. And we covered that for the lender. And so it was a 5-figure loss that was covered by the lender. One of the more common ones, or one of the ones that we're more cautious about, is probably liens against new construction. And a well-known industry loss was in Vegas on one of the casinos, where there was broken priority. And I think that loss ran into the hundreds of millions of dollars.
Wow. For
construction coverage. And at that level, you have reinsurance agreements, and you have 4 or 5 underwriters that are sharing that. This is some of the complexity behind the scenes as well. When you get to some of these large mega deals, especially if they're construction, the industry will also, behind the scenes, spread that risk around inside of the industry so that it remains stable. And this is transparent to the participants in the transaction, but it allowed for the payment of hundreds of millions of dollars of broken priority construction liens that then ended up making the subcontractor base whole, or what have you.
Yeah.
So the money goes somewhere to make people whole in the transaction. So those are two extremes of an industry-wide one and then a local one where everyone was made whole because there was a policy.
And can you unpack broken priority, or what that means a little bit more for people?
Yeah. So and the laws are different depending on what state you're in. But if I'm a subcontractor and I'm doing work on a new construction, or actually if I just go in and do work on your house, I establish a priority for my work in terms of a claim against that real property.
Yeah.
And I say, I've done work. I have a certain period of time to either, 1, you pay me, or 2, if you don't, I can place a lien on your property.
Yeah.
And depending on the priority of the underlying loan, I may have priority over that loan. And lenders obviously don't like that.
Sure.
And so there's a very robust system behind broken priority, looking for broken priority, sometimes even construction disbursement services to make sure that if we're going to say that the priority isn't broken, we're the ones that have controlled the money. And at the end of the day, it's to make sure that the money goes where it's supposed to go and that no one can claim a lien of higher priority than the lender has on the property.
Got it.
If you have several hundred subcontractors doing work at different periods of time and lien periods expiring at hundreds of different dates, you can imagine that gets fairly complex to manage. And then if you have I wouldn't maybe call it outright fraud, but a construction project can snowball on itself pretty quick if it gets underwater. And depending on who's controlling the money and the draws that are coming, there's a lot of complexity there.
Yeah.
And so some of these transactions get really complex, especially if there's construction involved. Today, one of the complexities is also could be the financing. I mean, in Oregon, probably in every state, but in Oregon, the state housing authorities and the financing and the complexity of the bonds that go to putting those transactions together, we participate in all of that. And each of those participants has a different requirement in terms of what policy they want and what endorsements they want. What most people will never interact with is there's an endorsement manual with dozens and dozens and dozens of different endorsements that you can tack onto these policies for different reasons. I would never interact with that as a residential buyer or seller.
Sure.
But if I was transacting a particular type of real estate, sometimes it's the ground is leased and the improvements are owned, and there's a lot of complexity to the structure of the transactions, both from an ownership and a financing perspective.
Yeah.
And so the industry has developed all of these different endorsements that meet the needs of all of those parties.
Got it. Yeah, well, some follow-up questions to that. So obviously, people think about insurance as essentially being a fund that pays out claims, right?
Yep.
In other areas of insurance, those companies are required to have a certain amount of liquidity or assets and things like that.
Yeah.
Is that also true in title insurance? Like, what if somebody needs to make a claim and then, are there situations where those companies can't pay the claims?
Rarely, very, very rarely, and recently never. So yes, this goes back to kind of the savings and loan piece of little regulation, little requirement for reserves. Today, all of the title insurers have reserve requirements for the policies that they have outstanding.
Got it.
And it's either hundreds of millions or billions of dollars that sit in reserves depending on their outstanding policies.
The banks like you.
Banks like it because they do, because we got a lot of money sitting there. And we also have a lot of money flowing through our accounts because ultimately everybody's comes there. So pooled trust accounts are another complexity. I mean, you understand this. But no, all of the insurers today are rated by industry ratings. All of their financials are transparent. It's one of the things that lenders will look for is the ratings and their financials and their reserves, and make sure that if you're going to write me a $200 million policy, I want to make sure you can pay it if I have a total loss of title.
Yeah. And so on the other end of that, you talked about some of the complexity of these projects, whether in Oregon or elsewhere. Are you underwriting the customers? Like, do you ever say, we're not going to insure this project?
Yeah.
Okay.
Yeah, absolutely.
Yeah.
I think there are cases where you are underwriting the customer, but not in the way that you would, not like a credit underwriting or, but it is still a business, and maybe not at $100 million level. You're underwriting the project and everything needs to be the way that it is. But in some cases, you're underwriting the customer, yes. Yeah, and that gets to be a little bit of there's an insurability and a business risk decision that we're making.
Sure.
And it's why people in the markets are so important, because they understand the markets, the players in the market, and where there may be business risk and where there may be insurance risk. Those are two different things. But yeah, we would underwrite a customer.
Got it.
Yeah.
You talked about this book of endorsements, which sounds like more tailored for commercial transactions.
Yeah.
And you also mentioned earlier that title insurance companies, you're a neutral party, right? Do you ever act in some sort of advisory, capacity in terms of hey, you have this commercial project. here's some endorsements we offer you might want to consider, or is that something you're really reliant on the customer coming to you and asking for those specific endorsements?
No, we would rarely, if ever, act in any sort of advisory capacity.
Okay.
That would be up to the customer and their counsel.
Got it.
And I think the more complex the transaction, the more you probably need, unless you're very good at it, counsel and people that can tell you want this endorsement or that endorsement. Most lenders of size have in-house counsel that will be very familiar with this and know what it is that they want, but we would never suggest an endorsement to someone.
Got it.
If someone came to us or their counsel came and said, well, we want to protect against this particular risk, we would say, okay, there is an endorsement for that or there is not. And depending on the complexity of the transaction, we may do ad hoc endorsements, or the more complex the transaction, the more flexible it becomes in terms of what coverages you'll provide.
Got it.
But we would never go and tell somebody you should do this.
Yeah.
And to be clear, the title insurer is not a neutral party. They have a customer. It's the person paying for their policy.
Okay. Yeah. I guess. Yeah. Yeah.
The settlement service is the neutral part.
Got it. Okay.
And on the West Coast, those two things are 95% of the time, unless you get to Southern California, always the same thing.
Mm-hmm.
You get to the East Coast, totally different. It could be 50-50 where the insurer and the settlement agent is two different things.
Got it.
So completely different market dynamics there.
Yeah. And is the reason that it's different state by state, is that just kind of because of historical precedent? Is it because of regulatory reasons? Maybe both?
Both. Yeah, it's a little bit of both. You get to some attorney states and only an attorney can close a transaction. You come out west and lay people can close a transaction. The state of Washington is actually the only state in the country that the Bar Association licenses people that close transactions and regulates them the same as they would an attorney.
Yeah, it's
only state in the country.
LPO or
a limited practice office, and they actually admit you to the bar for the limited practice of law. And those people that hold that license can be held liable in the same way that an attorney can, who's licensed to the bar and sued personally.
Yeah. Oh, well, that's the next level of risk.
It is the next level of risk for closing. I think it's a great. One of the few times I would advocate for government regulation.
Yeah.
But I think it's actually made the business more professional, and makes the people who do it sit up a little bit more and pay a little bit more attention.
Take it a little more seriously.
Personal liability. So more states should do it.
There you go. Maybe I'm surprised Oregon hasn't done it. I feel like Oregon and Washington tend to have a lot of similar ideas.
Yeah.
So
maybe the bar isn't interested in it. I don't know.
Who knows what's going on at Oregon's bar? It's crazy. So, when purchasing, an apartment building, multifamily structure, what additional title concerns, should, investors be paying attention to? Like, they've got a checklist, of here are the things I need to be thinking about. What would you want to see on that checklist?
If it's an existing building,
let's use that as an example.
Then I think I would just look for all of the regular things. Are there any things with the real property itself that you want to pay attention to? And the more urban the environment, the more you may want to look at that. Sometimes our exam will reveal code violations or existing issues that you may not be aware of. Always looking for encroachments or easements or anything that would restrict your ability to do something with that existing piece of property. Zoning, I think you'd want to be aware of all of those things. If it was damaged, if it was in some way a total loss, what could you reconstruct? There's maybe a lot of things that you'd want to look at there. And you'd obviously start from whatever the report was that came out, and it'll give you the condition, and then you'll kind of go from there. And then there can be some other complexities, overlays that come from the municipalities. Sometimes, depending on when the property was built, there's tax deferrals or other things that you want to be aware of.
Yeah, that's a good point.
That might be disclosed in the financials, but you maybe not. And so in that case, depending on, again, when it was built, you'd want to say, should I look for any concessions? I would particularly look for that now. And is there something that's coming later on that's going to increase my cost? New construction, you'd look for all of those things, but normally new construction's a little bit more cleaned up because somebody's got a construction loan. in that case, you're very concerned that your policy is either clean, we would call it a clean policy, which says that there's no liens, or if it's a dirty policy, we would call it that you've done your due diligence to make sure that you're okay with the gap between broken priority. That would be the number one thing I'd be looking at in new construction.
And so you talked about, WFG essentially providing two different services, right? You've got the title insurance component and you've got the settlement services. Are there other services that WFG provides that you think investors should know about?
Yeah, I think we'd provide a lot of assistance with development. So we will help customers develop land or help them through, all the way through platting. I mean, we will assist with and run the entire platting process if they're going to redevelop or plat property.
Okay.
We would help them through zoning changes. There's a number of things that we would help with and have services. We have a development services department that would help through that process and guide through that process and help interact with the different surveyors and engineers and attorneys and kind of coordinate that process to drive it to a close in all the different municipalities. And oftentimes a policy would come out at the end of that as well, depending on the structure of that transaction, but it doesn't necessarily have to.
Interesting. Okay.
So we do help with that.
Got it. And obviously you guys have access to an enormous amount of data, right? So ownership information, just general market perspective. Do you help people with sourcing or identifying off-market opportunities?
We can. Yeah. Okay. Yeah, we absolutely can. So yes, we have access to lots of data sources, a lot of information about properties, potential off-market opportunities, non-owner occupied opportunities. Yeah, we can also assist with that depending on the nature of the customer. Okay. So we generally aren't providing that to somebody that would walk in off the street and say,
Yeah.
I mean, we would want to know that we're interacting with a real estate professional and what they were going to do with the information. And that information is increasingly accessible today to anyone that would want it. So we do not provide non-public information. So there is no information that we have that is non-public that we would provide.
Got it. Okay. Interesting. What would be an example of like non-public information that somebody might want that isn't really out there?
I would say any sort of transaction that hasn't closed or is publicly available that is in the pipeline.
Got it.
Any sort of application for a change in zoning or some other transactional part of a property that we would be aware of that's not been made public yet. So there could be any number of things that have happened before whatever that is recorded and become of public record that's accessible through an auditor's office. None of that, we would not disclose any of that.
Got it. And that sounds like maybe primarily for confidentiality reasons. Or...
Yeah, that would be for business purposes. We would obviously not be allowed to disclose that. So,
yeah.
And no one in the industry would.
Yeah.
So anything that we're working on that we would be aware of that hadn't hit the public record, we wouldn't disclose. I don't think there's, I'm trying to think about other things that we would have access to. I mean, obviously any of our transactional data we would not disclose. And there are states that are non-disclosure states that you don't know who's buying and selling property, or you may not know the price.
Got it. Yeah.
We would know it. We would not disclose that. So you get to a disclosure versus a non-disclosure state. We may have a bucket of information about a certain number of properties where we know things that aren't a public record. We would not disclose that.
Got it.
Ownership or contact information that we might have that isn't public record, we wouldn't disclose that.
Okay. So that kind of brings up an interesting point. Sometimes I've seen in Oregon, deed recordings that don't have a price. They don't tell you what it transacted at. Is that a gray area for you guys? If somebody called and said, hey, what did this property sell for? Would you be able to say that? Or do you not have that information because it wasn't provided?
Well, if we closed it, we'd have the information and we wouldn't tell you.
Okay.
So we would tell you what was of public record.
Interesting.
Yep.
Got it. And why do some people decide not to disclose transaction price and others do?
There could be a number of reasons why. The consideration may be not entirely monetary. There could be a host of complexities behind that. I'm pretty sure in the state of Oregon that they require that you disclose some consideration. Washington, as a for instance, has a standard, $10 and other good and valuable consideration. Yeah. So most deeds will require that consideration is passed for it to be valid and legal. So those deeds would say there was some consideration. They may just not disclose the price. And those parties may not wish to know. It could be a trust or a fund, or it could be any reason that they would have for not wanting to disclose that price. And I don't know what all of them would be, but
sure,
there has to be some consideration listed on the deed. Sometimes there's complexities inside of the entity that doesn't allow them to disclose. I mean, there could be a lot of reasons why. It's pretty rare, though, that you don't see the disclosure.
Yeah. I've only seen a few times, you're looking something up maybe on Portland Maps or something like that, and you try to see, and it may just be that it's an old enough transaction. They just decided not to publish the information, perhaps. But I mean, I imagine if you're trying to acquire, neighboring lots, adjacent lots, that maybe you don't want that to be known because you don't want to set expectations.
I don't know that you can just arbitrarily decide.
Okay.
I don't want to disclose it, or I do want to disclose it, because I'll go to something that's kind of adjacent to this, but so there are some cases where a buyer or seller would not be disclosed, where it would be redacted if there's a court order that protects that person, if there's an order of protection in place, or something else in place from the court that would say, okay, we can legally keep this from the public record.
Witness protection or something.
Yeah, witness protection, or stalkers or violence or other things where it's been through the court and it says we're not going to disclose that this person is buying or selling real estate.
Got it.
So we would know, but it would be redacted of the public record. So that's one method where you may get some set of information redacted from the public record. But generally, I think most of the time disclosure is required in the state of Oregon for a sale price.
Okay, that's good to know. Okay, great. So why don't we transition to a little bit of, market perspective, right? You're in a unique position in that you see a lot of transaction volume, right? And so it's kind of telling you a story about the market. What are you kind of seeing right now? Are you seeing people, investors in particular, being more active? Are they being more cautious right now? Like, what has some of the data been showing you, especially, so far this year? We're halfway through the year. Is it, kind of what you expected it was going to be like, or has it gone in a different direction?
Yeah. You sure you want to stop talking about title insurance?
As interesting as that is, I know we could probably go for hours, but I think we want to get a little bit more of the insight you have, because I know you've done some just incredible presentations on the local economy, the macro economy, and so I think people would really enjoy that.
Yeah. So I would say investors are generally always active in any market. That is one thing that we have learned, and the pricing signals for investors are, I think, paid attention to much more closely, and they act on them much faster because the motivation is obviously completely different than me or you buying a home we're going to live in. So investors are always active, and the deal structure just becomes harder depending on where you're at in the cycle. So if we're talking about single family residential real estate, we have very active investors always looking for property that they can take, add value to, and put back into the market as inventory, which is a positive. I mean, it's one of the things that I think in this market and across many other markets continues to provide inventory where otherwise we would not have inventory. Multifamily commercial investment, that is just a much more pure pricing signal play. And we've seen some of that in Oregon, not just here, but in other marketplaces where you're looking at large sort of headline assets trading at 60, 70% value drops.
Yeah.
And that signal's pretty clear. Somebody then comes in, recognizes the value, buys it. It's a much cleaner marketplace. So we always, I think investors are always active, and the pricing adjusts a lot faster. As they signal to each other what it is they're willing to transact at. In this market, like many markets, there's some speculation now about, well, what's the next 5, 6, 7 years going to look like? People are kind of reading the tea leaves and saying, is this the perfect timing for whatever their goals are? But investors are always an active part of the market. Their desire to transact is undiminished. Their ability to transact, depending on the market cycle, is different. And so I would say right now, the desire remains high, as it always has. The ability is probably, like in other parts of the market, diminished somewhat. And it depends on your cash position, a lot of other things, but very active investors in our market, which is good. The longer term, if we're looking at the overall market, I think that we've kind of gone from mega cycle to mini cycle to mega cycle. And the first mega cycle, whatever, we'd call it whatever we want, but was 2005 through probably 2012, 13, and where we just fundamentally changed our marketplace all across the entire nation. The Fed's role in home financing completely changed at that point. And this set up the big run up, the drop off, all of the attempts to fix that. We come up into a kind of a stable market. COVID, completely changed the marketplace, both on the investor side and the just regular purchaser side, residential home purchaser side. We had this very short, intense cycle that now will carry us into this next cycle. And some of that is, the value destruction we see in commercial real estate. That's part of that cycle. Little less apparent to most people, but the feature is on the residential side, is very, very low transaction volume and pretty high sort of sticky pricing.
Yeah.
And
it's interesting. Yeah.
If you look at, we've had 4 years, I think, of near 4 million residential transactions, historically low. We should be.
Is that national?
National, okay. A national number. We should be closer to 4.75 to, let's call it 5.5 million.
Okay.
So you have a lot of, the big chunk of what we would call normal transacting that didn't take place. And one of the things I think a lot of people don't realize is, I think we tend to think of COVID as a really, really intense, like the most intense cycle. But from a transaction velocity perspective, the 05 to 08 run up was 30 to 40% higher in terms of transaction volume.
Oh, that's interesting.
With fewer people.
Wow.
In the metro market specifically. Yeah. So we had a really brief, intense amount of transactions during COVID, but a massive amount of those were refinancing.
Yeah. And
it's one of the reasons that our country has probably weathered inflation a little bit better than a lot of other countries, because 60% of homeowners have a fixed rate below 4%.
Yeah, that's wild.
So when you have a real world negative interest rate fixed for 30 years, you might gripe about the price of eggs, but you're in a better position to absorb it.
Yeah, absolutely.
It's one of the miracles of a 30-year fixed rate mortgage. I think we're one of only 3 countries in the world that has such a thing.
Yeah.
And it's probably the most effective way for a household to hedge against inflation, is to take on a large amount of debt, somewhat counterintuitively, and fix the rate of that debt at a moment in time. So we, I think, have survived. It accounts for some of the strength of the consumer in the market more broadly, because when you've dropped $400, $500, $600, $800 off of your mortgage payment, you still experience some of the wage gains that were inside of the marketplace, and now you might be stuck in your house, but you can consume.
Yeah, no, that makes sense. And I guess speaking of interest rates, how have they impacted investor behavior over the last few years?
From an investor perspective, obviously rates are a massive part of you writing your pro forma as to whether or not this makes sense or not. We saw private companies get driven out of the market during COVID because interest rates were so low. There was a lot more institutional money. Private investors came back afterwards, higher cost of capital, but they made more sense. Speed to market, a lot of other things. I think that there's a lot better underwriting being done, and the valuations can't get so out of control because the interest rate's constraining that, which is the point, right?
Yeah.
To not let that kind of run away. But you could go back, you could go back to when interest rates were incredibly, historically, artificially, I might add, low.
Yeah.
and you make an assumption that this is the market you're functioning in, well, the valuation just becomes crazy.
Yeah, balloons and
yeah. And so what follows on is, hey, if I can get a loan for that, then you pay less attention to your construction costs or whatever else it is. You don't manage those things as closely. And you just get this ballooning price if you don't have discipline inside of that transaction. The interest rate allows also maybe people who shouldn't be involved to get involved, that aren't as technically proficient or experienced to come into the marketplace and start to mess around, which also then starts impacting volumes. I would say today you have very disciplined investors who are writing and underwriting their transactions in an environment that makes a little bit more sense. And what you're seeing is the pricing signals adjusting for the interest rate.
Yeah, starting to. It took a while.
Yeah.
It took a while. I think that's really like, I've seen maybe in the last 6 months, maybe 12 months, that adjustment, with cap rates and, seller expectations. I mean, I've talked to a handful of people who've closed a few different multifamily deals, and some of these people are, closing transactions where they had presented these same offers 6 months ago and they got rejected. And now those investors or sellers are coming back and saying, okay, we'll accept that.
Well, and I think that is the point at which the market has begun to, when you have seller starting to capitulate and they say, okay, I've adjusted to what the market is. You can want it to be different, but if you underwrite it like you're the buyer, it's like, well, there's only one other lever left to pull, and it's the price.
Yeah.
And unfortunately, you bought into one market and you're selling into another one.
Yeah.
And interest rates are everything in that environment. If the cash flow that asset's developing is not competitive in the marketplace, you're going to go somewhere else. So that part of the market is a little bit less emotional, and ironically, it's less emotional the higher the cost of the asset is.
Yeah, that is interesting. Yeah, I've noticed that as well. And one of the early signs that mentality was shifting was buildings being priced based on actual rents and not projected rents.
Yeah.
Because there was a period of time where people were selling these assets based on what you can get.
Yeah.
And right now, you see some of that still a little bit, but for most part it's on actual rents.
That's moved to AI stock valuations now.
Yeah. That's some serious volatility in there, but that's going to be really interesting.
So let me ask you a question. So
Sure.
When it comes to pricing based on projected rents, was that a new phenomenon in the marketplace? Was that something that kind of grew up in the low interest rate environment, or is that something that you see happen through the market cycle?
I think that it was mostly with the really low interest rate environment is where I noticed that to be more present. And it was just because, some of this was also before rent control in Oregon. And so it was kind of just like, some of this was even before Portland relocation. So some of it was basically like, look, you buy this building, you can get these rents in a reasonable amount of time. And a lot of it was just probably because some of the sellers were people who had owned these assets for a long period of time. They didn't want to go through the process of increasing the rents themselves.
Yeah, okay.
Whereas, then there's a period of time where these regulations were in place. And that's also where you've just either got some, brokers that are expecting maybe the buyer's naive or whatever it happens to be, where they don't know what all the constraints are. Meaning like, okay, well, sure, I can raise the rents. Like, for example, like when Portland relocation came into play, and there was no rent control, yeah, you could get the rents to that level, but it's going to trigger relocation. So $4,500 payment, $4,200 payment. So if you weren't familiar with those nuances, then that would create an issue. And then you had rent control, and then that's taking different forms, where it was CPI plus 7%, and now it's CPI plus 7% or 10%, whichever is less. So there's all these little mechanisms where you're like, okay, yeah, I could get those rents, but from a practical standpoint, operation, I can't. It's going to take me 5 years to get there, right? So you kind of have to know what you're looking at, but we are starting to see that kind of reset more towards some reality.
Are there markets where it would be reasonable to do that? So if you go outside of Portland, as a for instance, is there a time where it would make sense to say, all right, this is a rapidly expanding market. I do see that it's reasonable. I'll pay you a projected rent valuation today.
Yeah, I mean, I think there are times where it would make sense. I mean, if you're going to be holding the asset for a long period of time, then it probably becomes a little bit less significant to you. It also depends on how extensive the value add project could be. If you're talking about, units you're going to go in and gut, and they're telling you these are what the potential, rents are, then you're like, okay, well, yeah, that makes sense. And we have the tools to achieve it and so forth. But a lot of times, people were projecting these off not a lot of operational change, but more of just like, hey, you're going to go in and put in LVT flooring and update the countertops, and all of a sudden the tenants are going to pay more. And it's like, that's not necessarily going to be the case, because value add investing is effective, but it's also very risky because you're trying to anticipate what other tenants are going to be willing to pay, and your biggest threat to that is supply. Right. And that's kind of where some people have gotten stuck, is a lot of supply, certainly certain types of class of supply, like class A supply, kind of being too significant. So obviously, like, tracking some of this, economic behavior is important. So what sort of indicators are you looking at personally that you're kind of tracking closely right now to kind of be leading indicators for you, or to give you an idea of, hey, should WFG be ramping up its staff to deal with the incoming, potential orders?
Yeah. So from a purchase perspective, our basis is always two things, and it sounds simple, but it really is the basis for everything. Population growth, that could be either migration or household formation, and employment. So those are the basis for, we're a transaction velocity business, so we need residential real estate transactions in order to make our business work. So those two things as a basis, we're always tracking. And then from we can also close refinances and reorganizations. That's an interest rate driven play. And there was I forget who did the study, but there was a study that came out where there's some empirical evidence now about how much motivation or demand is destroyed when you get above the interest rate that people already have. So there's some models now that are starting to tell us what we should expect, but most people will refinance for 3/4 to 1/4 of a point. So anytime you get to a point where there's some folks that it would make sense for them to refinance, you get a point under, that's fine. We're not close to that now, so there's very little refinance going on. But employment and population growth are the two things that we look at. So population growth that cannot buy or sell real estate, transact in real estate, isn't helpful to us. Not that we shouldn't notice it, but just from our business planning perspective, doesn't matter. And if the population can't afford the price of a house, then you got a problem. And that problem exists a lot of places now.
Yeah. So you're thinking as kind of a third data set of, basically purchasing power of households and things like that.
Yep.
Got it.
Yeah. Pure population growth or household formation doesn't tell the whole story. You still have to have the ability to transact. And I said earlier about investors, I'll say it again about residential real estate. With great exception, everyone wants to own real estate.
Yeah.
It's not about desire, it's about ability.
Yeah.
And the ability to transact is a function of interest rates, pricing, but also employment and wages. So I think Oregon, if we're looking at, I think Oregon's median priced home, this is one measure, is 6.2 times the median salary.
Okay.
Detroit is 3.
Sure.
I think Kauai is 14. So as a, on the spectrum, 5.5 times is considered a constrained or unaffordable market.
Oh, interesting. Okay.
So we're at 6.2. So it's expensive, and you take away the $300, $400, $500, $600 that an interest rate gives you back. That's tough. It's tough. So, but the other thing that people don't talk about a lot, that I don't hear as part of the affordability conversation, is taxes and insurance.
Yeah.
And it's a significant contributor to the ability to make a monthly payment. And taxes, I think, on average have gone up 25 to 30% through COVID, and insurance in some cases 120 to 150%. And then depending on the market you're in, maybe even more than that.
Yeah.
So if your insurance premium and, some places in California is $30,000 a year.
That's wild. Yeah.
That's pretty wild.
Yeah.
So I think that's not enough of the part of the affordability conversation, because it's a significant and rising contributor to the ability to make a monthly payment.
Yeah. And when you're talking about taxes, are you talking about overall taxes, or are you talking about more specifically property taxes?
I'm talking about specifically property taxes. So that would be you're taking more money on a monthly basis, and then you could have another conversation about those places where you're not even receiving that money because of taxes.
Yeah.
Two different sides of that equation, but specifically property taxes, which are a big part of a monthly payment and an increasing part. So something that we don't talk a lot about.
Yeah, that's a good point. I mean, do you think that people are sitting, like for the people that are sitting on the sidelines of buying a home, do you think most of those people, the barrier to buying right now is that they believe interest rates are going to come down, or they just don't have the down payment to buy?
Here's what I've learned about most of us as consumers. When interest rates are going up, we believe they're going to come down.
Sure.
And when interest rates are going down, we believe they're going to come down further. We always think they're coming down. So there is some of that where, you get at 6.5, 6 3/4. It's like, oh, that's tough because I'm pretty sure they're going to go down. And, maybe that's a good bet that they are. Enough to make a big difference? I don't know. Maybe not.
Yeah.
But then there's a significant barrier for the down payment or the ability to afford the monthly payment. So we see a lot of, if you're talking about just residential real estate, we see a lot of gift funds to help people get into homes. And it's a much larger part of down payment than you might suggest. Now, if you already own a home, down payment's no problem, because you probably got some pretty significant equity built up, and you just roll that over into the next place. Yeah. Which is why it's so important to get your foot on the bottom rung of that property ladder.
Yeah.
Because that's how you get to the next one and the next one and the next one. But the other thing that I have noticed, and this is just anecdotal in our own business, is that the younger or first-time home buyer is, at least the ones that are transacting, are much more willing to buy whatever it is they can afford, rather than say, I want the HGTV house, or it has to be perfect, or they're willing to say, I'll buy what I can afford to get my foot on the bottom rung of the property ladder. And I think that's a positive.
Sure.
Unlike 08, 09, 10, where you can go back and read articles where everybody said, oh, no one's ever going to want to own real estate. It's terrible. We're all going to live in communes with, shared bathrooms, and it's going to be great. Well, we won't own. That has turned out to not be true. People want to own real estate.
Yeah.
Where in this cycle, it is, I want to own. It's really unaffordable, but I really want to own.
Yeah.
And so it's a different narrative this cycle than it was the Great Recession cycle. But people accepting what they can afford versus what they want, which I think is really smart. And then a lot of down payment assistance, where we've told our own kids, wedding or down payment, you choose.
Fair enough, yeah.
And we'll only give you money for one, and it's the down payment.
Smarter choice in the long run.
Yeah, I think so.
Yeah. Well, that's interesting. I mean, I think that, before, obviously we've been talking a lot about just the market, interest rates and mortgages, and you talked about the secondary market earlier. But like prior to all that existing, sellers would oftentimes just do what's called seller financing, right?
Yeah.
That's like how properties were sold, whether it was like on a contract basis or something like that. Do you think that that's going to be something that might emerge in the future, or do you think that that's just old school methodology that no one's going to do?
I don't.
Yeah.
No, not in any significant. I think our market's not really set up for that. Largely, you need to own the home free and clear in order to be able to do that. The people that do own their home free and clear are probably of the demographic that don't want to deal with a potential repossession or collection or anything else that may come along. So the premium to do that, I mean, there's a subset of people that will always be willing to do it, but at scale, no, I don't think so. And I think we have an entire generation or two that's so removed from that concept that they would just say, this doesn't make sense. And the financing market is robust enough now that there's probably a product for them, and probably one that is better suited than seller financing. I think seller financing has a really narrow window where it makes sense. And the problem is always an arm's length seller finance transaction.
Yeah.
If you know the person, it's totally different.
Yeah.
If you don't know them, where's your protection for collection? How do you foreclose if you have to? I mean, you don't think about if everything goes good.
No,
you think about, what do I do in this transaction if it goes
blows
poorly?
up? Yeah.
And most people are willing to say, I would take some premium hit, some percentage hit in order to just take my capital and go.
Yeah.
So I don't see that as a significant part. Down payment assistance, that's a significant part. That's something we're seeing more and more, where families are giving money sooner to help members get into housing.
Yeah, and that'd be interesting because, you can gift money up to a certain amount without that person having to pay taxes on it. And I wonder if they're going to do any sort of work around that policy in terms of allowing gifts for certain purposes that might be tax-free. Because, and maybe this is something that you would agree with, but my understanding is that, you were talking about population growth, right? Yeah. You're talking about household formation. Well, a lot of that kind of means like marriage and kids, right? Mm-hmm. Ultimately. Well, a big barrier to that is stability, which is oftentimes something that people see as like homeownership, right? Like a lot of times people are like, well, I don't want to do those things until I can afford a house, right? Yeah. And so that might be your kind of downstream effect of, prices either being too high or having challenges with down payments, is those things that you're tracking are not necessarily moving in the right direction. It could be for other reasons too, but
I could see the two things coming together as a longer term demographic cycle where you say, I can't own real estate, so I'm going to defer or delay family formation or having children, and that kind of compounds on itself. I could definitely see how in a longer cycle the two may influence each other. Yeah. I think actually one of the largest demographics of household formation, though, is single women forming up households, I think at a higher rate in the 20s demographic than any other portion of demographic, married or I have to check that number, but it's a very high percentage is single women forming up households.
Got it. Okay. Well, I guess this is the last kind of formal question I'll have about, professional stuff. Then we'll move to a few just quick questions to get to know you better. But, if you were advising, let's kind of put on the investor hat again, a real estate investor who's got capital to deploy today, what opportunities would you be telling them that they should be paying attention to?
Oh, that's a good question. I think there is, I'll kind of set this up with a few caveats first, but okay. Let's assume it's a sophisticated investor with capital and they kind of understand it's not their first real estate investment.
Sure. Yeah.
I think I might look outside of what I had traditionally invested in. So for instance, if I was traditionally a residential investor, I may look to other property types right now because the opportunity may be better there. And I might say, well, maybe is now the time for me to look at something that's a little bit outside of what I've done historically because maybe the pricing is better there. Sure. Or perhaps there's an opportunity that I'm not seeing. I might also look to buy, and this is like a little bit even more outside, I might be looking to buy businesses that own real estate and consider operating that business as well.
Interesting, yeah.
As a vehicle for real estate investment. And there can be some really good knock-on effects that come from that. And then if I want to stay in, let's say it's residential multifamily, as a buyer, I think I would probably become a lot more active at the price point that made sense for me. What difference is it to you if you make 27 offers and all of them are rejected?
Yeah.
You may get one that hits your price point, but the amount of, and you know this well, there are sellers out there that will transact with you.
Mm-hmm.
And so if I was committed to investing, I would become really, really active at the price point that made sense for me. I probably would be cautious about running to other markets that I didn't understand well. for a variety of different reasons. And I would probably stick to the market I knew the best and make the offers that I thought made sense for me, and I'd make a lot of them.
Cool. That's good advice.
Yeah.
It's always good to think outside the box, and sometimes there are opportunities that you don't see because you're not wearing that kind of lens. No, that's great. Well, one of the things we're going to transition real quick, I just have a few wrap-up questions because you've spent a lot of time with me here. Appreciate it. It's just some questions to get to know you a little bit better. It's a way for the guests to learn more about you, and it's always kind of fun. So one of the first questions I've got here is, growing up, what experience or influence, had the biggest impact on, who you are today?
Oh man, that's like a big, massive life question. I would say it probably wasn't an individual. It was probably the way I grew up.
Okay.
I was one of 9 children.
All right. Wow.
From the same 2 parents.
Even more impressive.
I know. And we grew up out in the country, and there was always people around, and it was a great way to grow up, and your siblings become your friends. And so I don't know that there was maybe a single influencer as much as it was the way I grew up. It was a great way to grow up, and it's unique. Anytime you tell people you grew up with 8 siblings, they're like, what was that like? It was great. You learned a lot.
Sure.
You learned how to negotiate. You learned how to share. You knew when you had power. You knew when you didn't.
Yeah.
You learned to fight for resources. I mean, you learned a lot of things. And I think you also look at the sacrifices that your parents make, and those you understand later on, but probably the way I grew up, and not an individual.
Got it. And did you grow up in this area, or did you grow up somewhere else?
So I grew up in northern Clark County, largely. I'm from Ohio, but came out here pretty young and grew up in the sticks in North Clark County.
Cool.
Yeah.
Fair enough. And so my next question is, you obviously have held really senior positions, in your career, obviously a WFG title and so forth. And prior to that, those roles require, they're demanding, right? From an energy standpoint, because you're oftentimes dealing with complex issues, not straightforward issues. What do you do to keep your energy up and just have that, stamina? Because it's something that you've obviously had to maintain for a long time.
Well, I think I like working. I've always enjoyed working. I don't mind working hard. So maybe there's some natural sort of motivation there.
Sure.
I will tell you, I've paid a lot more attention to my health in the last, 6, 7, 8 years. And you get to a certain age and you realize I need to pay closer and closer attention to this.
Yeah.
I'm not, 25. So I would say more recently, I've tried to do the regular things that you do, eat better food, drink less, try to exercise. I've exercised more in the last 5 years of my life than I probably did all the years before that.
Gotta start sometime.
And those things have made a difference in terms of just focus and energy. And but I'm also I don't and really never have burned the candle at both ends. I'm a in bed at 8:30 type of guy, and I'm up at 4.
Okay.
So
that balances out, though.
It does. That's what I mean. Yeah. It's like it's not like I go to bed at midnight and get up at 4. I go to bed early.
Yeah. When did you start that habit? I mean, I don't imagine you're going to bed at 8:30 when you're 25.
No, probably not. But I'd say it's probably been a decade that I've gone to bed early and I get up early.
Sounds good. Well, my final question here is, what's the biggest insight you've had from being a parent?
That one is easy. Your children are a reflection of yourself. And I think you also realize as you look back that your parents were just probably doing the best they could with the information they had at the time.
Yeah.
And they probably made some mistakes, and that's okay. And you want that same grace from your children because you realize, oops, I probably made some mistakes, and I hope you'll be okay with that. But mostly that they're a reflection and a mirror of yourself. And so both what you love and what probably annoys you about them is probably a reflection of yourself.
Fair enough.
Yeah.
Cool. Great. Yeah. Well, thank you so much, Noah, for being here today. Nick. This was great to learn a little bit more about the title world, WFG, and kind of your whole experience in there. So
Yeah,
thanks
good to be here.
Thanks for joining us.
Yep, you bet.
Cool.